Most traders overcomplicate scalping, but the truth is, it doesn't have to be. What if I told you that there's one simple mechanical strategy that allows you to pull profits from the market in just 30 minutes a day without being glued to the charts? This is the exact 1-minute scalping strategy that I use to make over 6 figures a month. No guesswork, no fancy indicators. And I'm not just gonna be throwing theory at you. I'll break it down step by step, and at the end I will show you real backtested results to prove to you that this actually works. Numbers don't lie, so trust me, I didn't pull this out of my ass. With that said, let me break down this entire scalping strategy into 3 simple steps that you need to follow. The first step, we are only going to be using 2 time frames. Your higher time frame will be your 15-minute time frame, and your lower time frame will be your 1-minute time frame. Right? We want to keep things very simple so that we can execute without hesitation, reservation, or fear. So as you can see on the screen, this is the entire scalping trade plan at a high level, and you can see that it only requires you to follow 3 simple steps. By the way, I'll leave this down in the description for you to download for completely free. So the first step is to identify break of structure. Remember, we always want to be trading with the order flow, not against it, because the market has already showed us where it wants to go. So all we have to do as traders is just follow it. So in this case, we got a bullish break of structure to the upside. Once you identify that, your first step is done. As simple as that. It's literally as simple as ABC, buddy. So the second step is to define your point of interest. This could be in the form of supply and demand zones, or order blocks, or flip zones, or simply zones that grab some form of liquidity. These are the zones that price is most likely going to react from. So all we want to do is to wait for price to come back to these zones, mitigate it, and that step is once price mitigated their point of interest, we jump down to our lower time frame and we execute our entry models. Now the next question becomes, what are the entry models? What do you want to see on the lower time frame itself? So very simply, once price mitigate your point of interest, in this case, this would be this demand zone right here, or even this extreme demand zone, you want to drop down to your lower time frame, right? Which in this particular scenario, it will be the 1-minute time frame itself. Now bear in mind that if you are not very experienced in trading, you can use the 5-minute time frame as your lower time frame instead of the 1-minute time frame, because the 1-minute time frame is incredibly volatile and you can be easily caught within the noise and all the freakouts if you're not careful, if you're not really experienced. But if you're indeed experienced and you have mastered the 5-minute time frame and you do want to catch those sniper entries, then feel free to use the 1-minute time frame as your lower time frame. Right? So once price step into your point of interest, drop down to your lower time frame, 1-minute time frame, and then you want to look for this pattern right here. So all we are waiting for is some form of liquidity sweep, right? So in this case, we got price creating like equal lows just like this, which we know that is just smart money building up available liquidity below these lows, right? All the retail traders entering for a buy position early right here, they're going to be placing the stop loss below the lows itself, which is liquidity to us, professional traders. So now we just wait for price to liquidate those lows right there, right? Once we got a strong liquidation, liquidity has been swept, smart money has came into the market, and then now it led to a market shift, right? Where price actually break past the lower high, which signaled to us that the internal order flow has shifted from bearish to bullish. And this pullback is about to be over, and right now the trend is about to shift bullish. So once you got a market shift, once you got your liquidity sweep, all you need to do is to wait for price to pull back to the point of interest, the demand zone, or the most recent zone that swept liquidity. And then once that happens, you just enter for a buy right there. As simple as that. I'm going to show you on the charts what this actually looks like. So just bear with me a little bit on the theory part, because you need to have this embedded into your subconscious before we can go onto the charts and try to spot it in real time. So that's one of the entry model. Another entry model is a failed reaction entry model, right? So in this case, it's the exact same scenario. But what happened was that price actually went up there, reacted to this supply zone that led to this liquidation, and it created a failed reaction, right? Which means that demand has overpowered supply, right? Because if this supply zone were to do its job, price will just continue going down even further, creating like a new lower high just like this, and it breaks structure, just continue this bearish order flow, right? But that did not happen, right? We got a failed reaction. And then what happened was that after the failed reaction, guess what? We got more liquidity being built up below this low right here, right? Because this is where retail traders who are entering for a buy early, somewhere around here, once again, they're going to be placing the stop loss below this swing low right here. So over here, price came down there, swept that low, right? Swept the liquidity below the failed reaction, and then it finally led to a market shift. So when this actually happens itself, we can see that this becomes our most recent lower time frame sweep zone that we want to actually enter the trade on. So all we have to do next is to wait for price to pull back to this sweep zone and then enter for a buy right there. As simple as that, right? So you can see it doesn't matter which entry model you actually see on the charts. The core concept behind it is that you just want to wait for price to pull back to the most recent lower time frame zone that swept some form of liquidity. It's really not rocket science, alright buddy, so chill. With that said, let's go onto the charts and look at some real chart examples so you can actually visualize what this looks like in real time with candlestick charts itself. So right now we are on USD CAD on the 15-minute time frame itself. You can see that we got a bullish break of structure to the upside. So we know that we should be looking for longs at demand zones that led to the break of structure itself. So this is where you want to mark up every single demand zone that led to this break of structure. We can always start from the extreme, right? So this is the extreme zone, and then this could be another zone right there, and then this would be another demand zone, right? So you can see it's actually part of like this little demand chain where price created a demand zone, price pull back to this previous demand zone, shoots up, and then it pulls back to this recent demand zone and just continue going up, right? So this means that this demand chain is most likely going to sustain itself, right? So once you marked up your point of interest just like this, you will see that it's kind of messy. We got a lot of zones every single where, and the question becomes, how do you know which zone price is going to react from? And the truth is, we don't, right? Because you must understand that trading is never a game of certainty. It is always going to be a game of probabilities. All we can do is to wait for price to come down into any one of these, our point of interest, and then once it does, we look for our entry model, and if our entry model presents itself, we will be looking to get in for the trade. So in this case, let's see what price does next. Okay, so you can see price went even deeper, right? So obviously it defied this point of interest, so we can just get rid of this one right here. And price actually reacted from this demand zone right here. So the minute price actually mitigates your 15-minute point of interest, you want to immediately drop down to your lower time frame to look for your entry model itself, right? So in this case, it touched the point of interest somewhere around here, right? So when this actually happens, jump down to my 1 minute time frame, and this is where I'm looking for this entry model that we have right here, either one of these entry model to present itself. So over here, this is where we want to see where is the most recent break of structure on the lower time frame, and you can see that this is the most recent break of structure, which means we are expecting price to take out this last lower high right here in order for price to give us a market shift. So let's see whether that actually happens or not, right? So price actually went down even further. Since price went down even further, that is where you can draw up your next internal break of structure, which is this one right here. And this becomes the most recent lower high, which we want to see price takes out, right? So let's see what happened next, right? Price continue going down even lower before price actually went up there and create a market shift. Okay, so in this case, we got our market shift, which confirmed to us that, you know what, this bearish internal order flow is about to shift bullish. And on top of that, we also got some form of strong liquidation, right? So how do I know that, right? Because if you look at what happened right here, price actually went down, right? Creating like some form of equal lows right here. You can see there's a lot of lows right here, building up a lot of liquidity below these lows. And the down price come down there, swept those lows before it actually push up, right? So we got a sharp V-shaped reaction just like that. Very, very beautiful sharp V-shaped reaction. So you can just put like your strong liquidation just like that. So you got your liquidity sweep, you got your market shift. What's the next step? The next step is to wait for price to pull back to the most recent lower time frame sweep zone, and then you just make your entry right there and then. So in this case itself, where is the point of interest that led to this market shift, right? So we can obviously see this right here is the most recent demand zone, right? You can see price was just consolidating around here, and then demand stepped into the market and caused price to go up there and take out this last lower high right here, right? Which means that this is the demand zone that we actually want to look to enter on. And remember, very, very simple. Right now, you just don't do anything until price step into your lower time frame point of interest. So this is where you can even consider setting an alert at this point of interest and then just wait for price to tap you into the trade itself. Okay, so price is consolidating. You're not panicking. You're not getting FOMO. You're not getting in here because that's not part of the plan. The plan is that you wait for price to pull back to your point of interest. Okay, so once that actually happens, you can see right here, price mitigate your point of interest. You get tapped into the trade right here and then. This is where you want to place your stop loss below the point of interest itself. Obviously, you don't want to put it super tight just like this. Give it a little bit of breathing room, at least 0.5 to 1 pips. And then you want to target 2R, right? So targeting 2R would just be like this, okay? So remember, for this particular strategy itself, we are going to be using fixed R trade management method, which means that we are always going to be taking profit at 2R. This way, we keep our risk consistent because consistent action leads to consistent profits. Right, so in this case, let's see what happens next, right? Price goes into a drawdown a little bit, but it doesn't matter because we know that this is the zone that price is going to be reacting from since this zone swept liquidity. So you can see price eventually go up into our take profit, and let's see whether price hit our 2R take profit or not. Right, so you can see price consolidate here a little bit, and then eventually price went up there and smashed our take profit. As simple as that, right? So it's really that simple and that mechanical. All you are doing is that you are waiting for price to pull back to your point of interest on the lower time frame, and then once that actually happens, you enter. Okay, so in this example right here, this trade actually took quite long to play out. So this was more of like an intraday trade rather than a scalp. Now, this is where it's so important for you to understand how to refine your point of interest. If you can refine your point of interest, you can hit your take profit faster, and you can have a much more higher risk to reward. So in this case itself, instead of drawing up the entire demand zone using the range method where we are marking up the entire consolidation that led to the breakout itself, what we could do is to refine it to the pivot candle, right? So this is like a pro tip that I've never really shared a lot, but if you're listening, good for you. So the pivot candle is basically the most recent candle that led to the breakout itself, right? So in this case, it will most likely be this candle right here. So you can see what happened over here. If you zoom in here a little bit, we got price coming down here, and then it led to price taking out this candlestick wick high right here. So you can see this is literally the pivot candle that led to this fractal break of structure sort of thing. So instead of entering right here, you could have potentially made your entry at the edge of this zone itself, right? At the edge of the pivot candle. Place your stop loss below the zone that is created by the pivot candle itself, and then just target 2R. So in this case, this would have been done within like, I don't know, 5 minutes or something, instead of waiting for 40 minutes or even like an hour for your trade to play out itself. Now, with that said, bear in mind that this refined method of marking up your point of interest is a little bit more risky because of the fact that sometimes price can just step into your range zone just like this, right? Not the refined zone, and it just goes up. In that case, if you're waiting for price to tap into your refined zone, you might not get tapped into the trade itself. So the pro tip is to find that sweet spot, right? Gather as much data as possible, which we're going to talk about later, and then find out what is the best method for you to actually mark up your point of interest. Now, let's look at another example in the bearish scenario, right? So you can see this time around, we have done our first step, which is identify the breakout structure, and we see that price is in the downtrend, right? So we know that we should be looking to short at supply zones, right? So based on this itself, you can see that this is the entire supply zone right here that led to the breakout structure itself. All right, so now we are expecting price to pull back to this point of interest, create like a lower high, and then continue to head back down. And we know that we are not going to be doing anything until price step into our point of interest. So over here, step 1 is done, step 2 is also done. So now you really just do nothing. And this is where so many traders mess up. They start getting itchy fingers, they start looking for low probability setups and start forcing trades when there is no clear opportunities whatsoever. So don't be that brokey idiot, alright? So now just do nothing, sit on your hands, set an alert at a point of interest if you want, and just wait for price to tap into that point of interest. Once that actually happens, that is where you jump down to your lower time frame to look for an entry itself. Okay, so once again, what you could have even done better is you can also refine this point of interest, right? Instead of marking up this entire range that led to this break of structure, find a pivot candle, right? And then just refine it to that zone itself. So it just be like this, as simple as that. Okay, so point of interest mitigation, which brings us to the third step, which means that we are going down to our lower time frame to look for our entry model itself, right? So if you go down to your lower time frame, you can see the internal structure is actually bullish. And once again, why did price actually turn bullish? It's so that we could facilitate pullback into this 15-minute lower high that we have down here, so that over here you can create like a new lower high for price to continue bearish, right? So now look at the structure. You can see that our market shift will only happen if price actually take out this last higher low that we have down here, right? So now I'm not doing anything until price take out the last higher low. Once that actually happens, we got a market shift, nice little market shift. Now you must ask yourself, is there any form of liquidity sweep whatsoever? Okay, so in this example, we actually got 2 liquidity sweep, right? So let's zoom in here a bit, and you can see what happened when price mitigated the point of interest. Price went up, right? Mitigated the point of interest, started reversing. This is so that it can induce the retail traders to enter or sell early, thinking that, oh, price is going to reverse right now. And then boom, smart money come there and stop you out, right? So we know that this right here is a good old liquidity sweep because we are professionals, we are not brokey idiots. And then once that actually happens, price went down there and led to a market shift, right? So this was actually our sweep zone, right? And this is also our extreme zone, which we have talked about earlier. Extreme zone, that swept liquidity and it also led to the market shift itself, right? So by right, we can just wait for price to pull back to this point of interest, right? Well, you're not actually wrong. You're like partially right. Because if we go back to our entry models, we can see that we haven't dived deep into this entry model itself, which states that we are waiting for some form of Fed reaction, and then we are waiting for price to come back to the most recent lower time frame sweep zone. Remember, the keyword here is recent. So if we go back to this diagram right here, this chart example, we can see that price actually came down here and it reacted to this little demand that we have up here. It reacted to this demand. And we know that if this demand zone were to do its job, price will go up there and take out this high to continue creating the higher high and higher low. But in this case, it failed to do that, right? Supply overpowered demand, and then it caused price to go down even lower. And when that happens, we got a failed reaction. And then what happens when you got a failed reaction? We got liquidity being built up above the failed reaction itself, right? We got liquidity being built up above this lower high right here. And then later on, price swept that liquidity before price actually created a market shift. Okay, so based on this itself, we know that we got our sweep zone right here, right? So this is the most recent lower time frame supply zone that actually swept the available liquidity from the failed reaction itself. So now we got 2 points of interest that we can look to trade from. It is flip plus sweep zone right here, right? The most recent lower time frame sweep zone, and also our extreme zone, which also swept liquidity. And both of them not only swept liquidity, but it also led to the market shift itself. So we know for a fact that both of these zones are institutional zones that we can actually look to sell from. Okay, so now it's just a matter of waiting for price to actually pull back to this most recent lower time frame zone that we have marked up right here. So over here, we're not going to be doing anything. Actually, in fact, let me just refine this zone, right, to just the pivot candle itself so that we can really get like the best entry possible, right? So I'm not doing anything right here. You can see price consolidating, doing its thing. You're doing nothing because it's not part of your trade plan, and you just stay calm, meditate, whatever you want to do, and then just wait for price to step into the point of interest. Once that actually happens, you can see price step into a point of interest. You enter for a sell position at the edge of the zone itself. You place your stop loss above the zone, right, and just target to just like this. Okay, as simple as that. So you can see price actually went up there. Okay, wait, bear in mind that you need to give your stop loss a little bit of breathing room. This is what happens if you don't give your stop loss a breathing room, right? If you put it super tight just like this, get stopped out just for price to go in your way. So you want to give it to at least like a 0.5 pips buffer or even like a 1 pip buffer, right? So if you give it like a 1 pip buffer, you can see price go near your stop loss, but you don't get stopped out, and then later on price go into your way and smash your TP at 1-2R just like this, as simple as that, right? But let's say you do get stopped out, right? Let's say over here you stopped out. Okay, cool. You accept the loss, you bite the loss, and you move on to the next trade opportunity itself. And where do you think is going to be the next trade opportunity? This zone right here. Because remember, this zone has not been mitigated whatsoever, right? So over here, when you take a loss, you're not giving up whatsoever, right? You know for a fact that trading is a probability game and you can't win every single trade. You continue to follow your edge. You just move on, right? You just bite the loss and you move on, and you just get rid of this point of interest. And now you're waiting for price to pull back to this point of interest that we have right here. And then once that actually happens, let's see whether you get tapped into the trade or not, right? So here, once again, not doing anything. Place my sell limit order right above this zone itself. And then eventually, price goes up there. It goes up super duper high up there, and it taps into our refined zone, right? Let me just mark out our refined zone right there. Okay, so this is our refined zone. This is where you should be placing your stop loss. I mean, this is where you should place your entry. And then your stop loss will be above the zone itself. And then you can just target to just like this. Right, so in this case, we already been tapped into the trade. Let's see where the price go down and smash our TP. It did, as simple as that. Right, so you can see, let's say over here you got stopped out, right? It is what it is, you move on. You find the next opportunity, and then over here, you win the trade. So over here, you lost 1%, and over here, you won 2%, right? So right now, you're actually up 1%. And that's what trading is really about. It's not about how many times you lose. It's not about how many trades you win. It's about how much money you lose when you are wrong and how much money you actually make when you are actually right. And if the profits always outweigh the losses, it genuinely doesn't matter the next time you take a loss because you accept the fact that it is a variance. It's part of this large sample size of trades. And you know for a fact that if you continue trusting your edge, you will eventually be profitable at the end of the month, at the end of the week, at the end of the quarter, at the end of the year itself. And that's really how I trade as a professional trader. And I know some of you guys might be thinking, does this actually work, Brad? And to prove to you that this actually works, I've actually gone ahead and backtested 100 trades using this exact strategy. And here's the results, right? So let's assume that the starting balance is $1,000, right? Because you are probably a brokey and you don't have 6 figures like me, right? So in that case, you start off with $1,000 and you risk 1% per trade because we are not reckless idiots. We are professionals here, even though we have a small account. So we risk 1% per trade. So that's about $10 on each trade, right? Like that's pennies, right? So in that case, we are using a 1:2 risk to reward and assuming that the win rate is 45%, right? Because this strategy actually works. So it's at least 40 to 50%. And we have taken 100 trades. Here's the results, right? Obviously, 45% win rate does not mean that you are literally winning 4 trades in a row and then you are losing the last 6. Or you are losing the first 5 trades and you're winning the next 5. No, it's random. And that's something that you must understand. Right? So in this case, right here, we win the first trade and then we lost the next 3. Right? So we were actually off to a bad start. Right, so we lost the next 3, but then you can see we get back to break even, and then we slowly start getting good again. And then you can see just over the span of 100 trades, we managed to end off the account balance at a whooping $580 profit. So imagine this: you deposit $1,000 into your trading account, and you got back $580, right? Which means you literally make back 58% of your account over the span of 100 trades, right? So this could be 1 month, it could be 3 months, depending on how frequent you actually take a trade. Let's be real, if you're a scalper, this could probably be like 1 month, right? So in 1 month, you made about $580 based on your $1,000 account. And if your account had $10,000, you would have made 5.8K. And if your account have $20,000, you would have made 11.6K using this particular strategy itself. And how do you get an account with 20K if you only have $1,000? Well, go and get funded, buddy. Because if you have access to a large capital, it becomes so much more easier to actually make a lot more money. So if you have a lot of money, you can make a lot more money. That is why I can make 6 figures a month. It's because I have a large account. It doesn't mean that I'm a better trader than you. It just means that I have a large account. Like, just look at this. If you have 100K in your account, this strategy allows you to make 58K. And if you have $1 million in your account, this strategy allows you to make $580,000. And as you can see, this isn't just theory. We let the results speak for itself because at the end of the day, numbers don't lie. And by the way, this is not just working for me. It worked for my students as well, right? For example, Samudin right here, who recently made about $26,000 on a goddamn Monday morning, just by scalping gold using the mechanical trade plan that we have given him. And on top of that, it's not just Samudin alone. Once again, if you look at our win section, you will see that every single day people are winning, like Kevin right here, who made about, I don't even know how much money is this. I think it's like a few thousands of dollars. And then we got Corey here as well, who got his first payout on a small 5K account of $700. That is quite a significant amount for like a small account. And you can see it's people winning every single day, right? 1 day ago, 3 days ago, 5 days ago, 6 days ago, and this goes on and on and on and on because our trading strategy actually works. Our proven mechanical trade plan is not something that is random. It's something that we have backtested time and time again, and it has stood the test of time, right? You can see there's over 100 plus of like this student wins posts. So if that's it, if you want to learn more proven trading strategies just like this one right here, which allowed me and my students to consistently profit from the market itself, check out the 1% Club, link in the description. Because inside the 1% Club, we not only teach you about strategies, we teach you about mindset, we teach you about trading psychology, how the market actually works, how to manage risk, and how you can scale your account to 7 figures like a professional trader. And by the way, this is the only place where you're able to learn from 3 professional traders with over 20 plus years of combined experience. People who actually know what they're doing. Like I said, the secret to becoming successful at trading is to just follow traders who are successful. And this is the best place to do it. So if that's it, I hope to see you inside the 1% Club. And as always, remember, you're just one trade away. And if you want to see more lessons on marking your point of interest, check out this video right here. All right, go on, click on it. What are you waiting for? For me to kiss you?